Hello and welcome to this special edition of Market Masters. I am Manoj Singhal, with me Nigel D'Souza and Manisha Gupta, and Chris Wood, Global Head of Equity Strategies at Jefferies, has released a report last week. He expects the Sensex to hit the 100,000 mark or 1 lakh in FY27, somewhere towards the end of 2026 or early 2027. To talk about the factors that are likely to take the Sensex to this level, he is now joining us. Chris, good evening and thanks a lot for taking time out for us. I was going through your report, and the point you're making is about 15% Sensex EPS growth and 19.2 times, so roughly thereabout, multiple. And if that is the case, then 1 lakh Sensex or 100,000 Sensex. But you know, the big worry which is emerging is that will emerging markets continue to get this kind of valuation, or will there be a bit of a reset because of what the Fed is doing? I wanted your thoughts on that first.
Well, that's a very fair question. Clearly, the Fed tightening cycle creates risk for high PE stocks globally, but the biggest risk, I think, relates to the US market, because the US market has been the most expensive market, and the source of the inflationary pressures we see today are primarily in the US and other G7 countries. They're not in Asia, be it China or be it India or other areas of the emerging markets. And the difference is very clear, because the relative lack of inflationary pressures in Asia reflects the different policy response to the pandemic. When the pandemic hit in early 2020 in the Western world, there was gargantuan monetary and fiscal stimulus, which led to a lot of people in those US, Europe, or UK being paid lots of money to do nothing. That created artificial demand, which has stimulated these inflationary pressures. In Asia, that did not happen. So you've had significant fiscal easing in India, for example, but my understanding is that most of the fiscal easing in the budgets we've seen in India have gone primarily to boosting capex in infrastructure, not in transfer payments. Okay. So I think there's a fundamental difference.
That point is taken, Chris. But here in India as well, a lot of sectors are seeing some overvaluation. For example, the Indian software sector, which is trading at perhaps 5 or 6 notches above its median valuation. You think that could be another risk?
No, that's a sort of sector that will be correlated to sell-offs in technology stocks in the US. But the key issue really short term is how much the Fed really tightens. And we will get buffeting in markets from that. There will be more tightening corrections. Another key issue relates to the Fed balance sheet. Does the Fed just do rate hikes, or does it start contracting the balance sheet? If it starts contracting the balance sheet in a meaningful way, that will make markets more nervous. So it's entirely logical for India to see corrections, because India is expensive in an emerging market context. But what's very encouraging so far in India is that I've seen significant foreign selling of Indian equities year to date, but the market has been supported remarkably well by continuing domestic flows in India. So that's very encouraging to me.
Hi, Chris. Always a pleasure talking to you. Well, you are looking at your report and you have highlighted that externally driven corrections, well, they would present a buying opportunity into the Indian markets. But I'm looking more inward. We have state elections that will come up. There are two risks I see out there. One is about the outcome. The second factor is once these elections are out of the way, then those petrol price hikes will come about, which will push up inflation as well. How big a risk is the state election outcome, according to you?
No, I'm more relaxed on that issue, because the general election is still a long way away. Mm-hmm. But I think on the oil price, that is definitely the biggest. There's two external risks facing the Indian stock market this year, primarily in my view. The one is obviously the Fed tightening, which we discussed, but the other is the oil price. And in my view, the oil price, in a world where we don't get a more lethal variant relating to the pandemic, and we return more and more back to normal, I think the oil price is going still higher. And the key thing driving oil is demand coming back after the pandemic, combined with extreme supply shortages. And these supply shortages reflect the political attack on fossil fuels in recent years, which has created a big disincentive on the part of the energy sector to invest in new production. So the world is now dealing with the price consequences of its stated desire to undergo energy transition. The problem with this energy transition agenda is many of the people advocating it have not really been focusing on the fact that in 2020, which is the last data we had, 83% of world energy demand was still met by fossil fuels.
Okay, fair point. Now, Chris, coming back to India, and one point which stands out is that you're quite bullish on the real estate space in India. I think, and you have been for some time. What's leading to that bullishness?
I know, like, to me, a key issue, both for me and my colleagues in the Indian Jeffrey office, we've been very focused on the residential market because you need evidence of a new investment cycle in India. And what's been extremely encouraging in the last year is that we've now finally have evidence of a residential property market upturn in India after a very extended 7-year downturn, which led to brutal consolidation in the property sector. And my view is that the base case is that now that the residential property cycle is underway and affordability remains very, very good, and we've got a lot of pent-up demand, my base case is this cycle should run for 5 to 7 years. So I've written in the Greed and Fear, and my colleagues have made the same point, that it looks to us that India is in a very similar situation to where we were back in 2002, 2003, which is the last time we began a residential property cycle in India. And that was followed with a 12, 18-month lag by a broader capex cycle. I'm hoping the same dynamic kicks in today. If it does, Indian economy and Indian market is going to prove much more resilient in practice to higher interest rates in India, just as was the case back in the 2003, 2007.
Just one more point, Chris, and from the Indian point of view, the Indian central bank, do you think is slightly behind the curve? The interest rates in markets have already moved on, but the policy rates have not. Your thoughts on that?
No, well, if you were being very conservative, you could say they're a little behind the curve, but I believe they will be raising rates. But I think this RBI is more dovish. The RBI in this current government, current leadership is more dovish than the predecessor. But in my view, the RBI was for an extended period there too hawkish, and you had too high real interest rates in India. So what's again very encouraging so far is, despite the relative dovishness of the RBI, that I would have to emphasize, the RBI has been nothing like as dovish as the Fed, the ECB, or the Bank of England in the last 2 years. But in the context of that relative dovishness and in the context of the high oil price, what's encouraging is that so far the Indian currency has been relatively resilient.
Chris, all the focus has been whether the Fed is going to do, 3 or 5 hikes, and what is China going to do in terms of some easing out there. But for the RBI, how many, where do you see the interest rates moving? At some point of time, RBI, they'll be forced to go ahead and start upping rates.
Well, I was expecting the RBI to first start raising rates this month, but maybe that will be delayed. But no, they need to raise rates a bit this year, but to me, that's not the prime focus. To me, the prime focus of markets will be, so long as the currency is behaving, they won't be under huge pressure to ease aggressively. On the Fed, we've had this extraordinary situation where we've gone from as recently as late September last year, with more than half the Fed governors were then saying there'll be no rate hike in 2022, to Fed governors and economists competing to who can raise the rates the most. But I would emphasize to your listeners, it's not just about rate hikes in the US. Just as important for markets is what the Fed does on the balance sheet. In China, the situation is extremely clear. China has now begun to ease. So China is basically in a different cycle from most of the rest of the world. China has begun incremental easing in the last 2 months. That will probably pick up momentum. And that's a positive backdrop for emerging markets, that China is easing.
Chris, you mentioned fossil fuels and oil a couple of times, and that has been an inflation concern as well. At a 7-year highs, above $90 per barrel, with most banks and brokerages talking about 100 as a possibility as well. While we have seen geopolitics as a concern and a strong demand, as you mentioned, and then, of course, the speculative push as well. What is your sense on where do you see crude prices going?
Now, I was very bullish on energy stocks last year, and the year before, and I remain bullish on energy stocks now because of this massive supply constraint in the oil market. In the short term, if this Russian-Ukraine situation is resolved, oil will correct, and then I would advise people to add to their exposure to energy stocks. What's incredible about oil is it's up at these levels today, even with much of Asia remaining closed, including China. If the whole world really reopened, oil could go much higher. So actually, to me, oil is the biggest single risk in the Indian market. And I would urge investors in India to hold energy-related stocks to hedge that risk as well as globally. So the best performing sector in the S&P last year was the energy sector, not tech, not FANGs. The best performing sector year to date in the S&P when I last checked is the energy sector.
And would you continue to bet on that going forward? I mean, are you looking at a 3-digit coming there?
No, to me, it's almost inevitable oil's going to 3 digits. The only question is whether and probably much higher. The only issue is whether they resolve this pseudo conflict in the Ukraine short term, because then oil can correct $10 and then you should buy it again.
Okay, no, that's an important point you made, that perhaps oil would be one of the big risks for Indian market, Chris. And I remember the fall that we had in 2006, driven by the high crude prices. But what about the selling by the foreign investors? It's only picking up every day almost. And while we have seen quite a bit of that being absorbed by the domestic investors, in a lot of large stocks, we are now seeing aggressive selling. Do you think that could also go against us this year?
No, that definitely can go against India in the short term, because emerging market investors will be tempted to take money out of India because it looks expensive because of the Fed tightening risk, and they'll want to put more money into China because China's easing. Also, the Chinese market is much more defensive relative to Fed tightening than India. The reason why is because the Chinese tightened last year, and the currency, the renminbi is rock solid. So if the market's correct on Fed tightening concerns globally, China will outperform.
You know, Chris, you made a couple of points about higher energy costs. That normally pushes up some base metal prices. It could support, metal prices as well. Given that China is likely to restrict supply of steel, of aluminum as well in the broader markets, do you believe that metal stocks here in India, they offer some kind of value post the recent correction?
No, I like industrial metals as well. They're all part of what I've been advocating. I've been advocating investors for several quarters, not just own growth stocks globally, but in cyclical stocks. And the obvious cyclical areas to own globally have been energy, industrial materials, and banks, because banks profit from higher bond yields. I'm talking in the developed markets more than emerging markets.
Chris, you said you've been bullish metals, and when you look at the kind of super cycle that commodities perhaps were put into, it was said that number one could be energy, and second perhaps in sense of metals. You also mentioned earlier about the green wave or the energy transition. Are there any particular metals that you're picking up?
Well, I think the obvious areas of benefit from energy transition and EVs, etc., are copper and nickel. So I think it makes sense to be positioned in these areas long term. Personally, this energy transition, though, will add, we've got all these inflationary concerns globally, which have been primarily driven by hugely expansionary monetary and fiscal policy in the US and the G7 world. But you also got the inflationary pressures being driven by the supply chain bottlenecks, which have been created by the pandemic. But then you have this other issue, you have this politically driven energy transition, which you may agree with it or not agree with it, but what's becoming increasingly clear is that this is an inflationary transition, as we see in these prices. So all these things are adding to the inflationary pressures. But the prime cause of the inflation is the explosion in US money supply growth, we've seen since early 2020.
Chris, coming back to India, then what's your view on the budget which was presented last week, and whether that would lead to more investments in capex-oriented sectors and stocks in India?
Well, to me, the budget last week is a pro-growth budget, which is a follow-on from last year's budget, which is basically prioritizing government investment in infrastructure, government capex. So to me, that's positive, and therefore I'm much less concerned about the fiscal deficits projected as a result of these budgets, because the spending's going into investment, which should be productive for long-term growth, is not going into transfer payments. And the hope will be that the government, by creating this, government capex-led infrastructure build-out, will create a sort of framework that will make the private sector more bullish and therefore more willing to invest itself.
One feedback, Chris, that came in post the budget was, yes, it had a good infra push, good capex push, but on ground, to spur the rural economy, that was missing a little bit, which could hurt sales maybe of two-wheelers, of tractors, some parts of the auto space. Your view on the space, on the auto space in this sort of a backdrop?
Well, yes, I'm not emphasizing the auto space in I do have an auto stock in my portfolio, but to me, that's not the prime drive of the government. Is to improve the macro framework based on my discussions with members of the government as pre-lost in India, which is now more than 2 years ago, to create a macro framework which will encourage the private sector to invest. And private sector balance sheets seem to be in much healthier condition. So I think the overwhelming odds favor that we will see this housing recovery lead into a broader capex cycle. And higher rates should not derail that, in my view.
Okay.
Higher interest rates.
Chris, another thing that the Indian budget threw at us was the taxes on crypto holdings. I mean, I do remember from your last conversation that you said you have increased your portfolio in Bitcoin at the cost of gold, where you have reduced holdings. First of all, what is your portfolio looking like when it comes to cryptocurrencies?
No, well, the crypto is a very interesting long-term story, and I have a bit of a weighting in Bitcoin, that's correct, but still much less than gold. But I would have to say that if the Fed is serious about tightening, which at the moment it appears to be, then the crypto asset class is going to be vulnerable while monetary tightening is happening, just as the high beta profitless tech segment will be vulnerable, and just as the areas like biotech are vulnerable, because these are high, long-term growth stories without a lack of profit short-term. But to me, in a Fed timing cycle, Bitcoin will outperform the other crypto vehicles, because Bitcoin is basically a store of value like gold, where some of these other crypto assets like Ethereum or Solana are basically equivalent to high beta tech stocks.
Chris, I was also reading a Jefferies report on Web 3.0 and Metaverse, and it seemed quite bullish, though. While we clearly could be in the years of infancy right now, how soon, how much of an investment, and how bullish are you on these themes?
Now, these themes are all very interesting, and if the Fed has suddenly announced today it was going to stop tightening, all these areas will come roaring back in performance. But for now, we're looking at such a dramatic change in the Fed position. I've never seen such a U-turn by a major central bank in my life. That for now, all these areas, in my view, these areas should be sold. If you're a trader, you should be selling rallies and growth stocks.
Chris, also, there are these theories on how the lifestyle as we know now could be changing, and not because of the holdings that there are, but because of the technology itself, but because of the kind of companies that are onboarding it, the institutions that are buying it, and a huge retail amount as well, especially in case of India. Do you see, I do understand, as you said, that the Fed is going to be the major point to watch out for now, but for a longer term, are we looking at a change the way we see economy?
In the longer term, in the longer run, crypto is potentially a huge deal because it potentially has the ability to disintermediate the banking system with this whole approach of DeFi, where people are borrowing and lending money using the blockchain technology. So it is potentially hugely disruptive. But that's, to me, a 10-year story. It's not in the next 1 year.
Okay.
Chris, one last question then. What's your view on the dollar? Do you think this year the dollar goes to 100 or the 90, the dollar index that is?
Well, logically, the dollar should be strengthening, given everything the Fed is saying and doing. What's interesting to me, actually, is that the dollar has not as rallied as much as the Fed has done a U-turn. So there's two ways of looking at that. The market could have already discounted these 4 and 5 rate hikes economists are now projecting. Or the market may be skeptical that the Fed is really going to be as tough as what it's saying. So while we have to pay attention to what the Fed is saying, and in the short term they can't do a big U-turn, we have to remember that I call this now the Jekyll and Hyde Fed, and they can just as capable of doing a massive U-turn in 6 months' time as they did in the last 2 months. We also need to understand that one reason the Fed has turned so much more hawkish is because by November last year, it became clear that there were political pressures on the Fed to do more about inflation. And those political pressures were coming from the Biden administration, because the Biden administration has been losing, based on opinion polls, losing the arguments to the Republican opposition because they're viewed as having created this inflation, and therefore they need to be seen to be doing something about it before the midterm elections. So this is the first time in decades that we have political pressure in the US on the Federal Reserve to tighten. That is a big deal.
Oh, that is a big deal, Chris, and of course that's perhaps going to be one of the big stories to track this year. And thanks a lot for joining us, and of course we'll try to get one more conversation with you in some time to see when things move in that direction. But always a pleasure talking to you. Thanks a lot for taking time out for us.
Thank you very much. Thank you.
Okay, that's a wrap then on this edition of Market Masters. Stay tuned with CNBC-TV18.